Record low interest rates are clearly great for borrowers, but they come at a huge cost and they carry a major risk that rarely gets mentioned. I mean, the cost is pretty obvious with savers being punished. I mean, for years we were told to save for retirement, but now that's virtually impossible. I mean, think about this. You could save $1 million nest egg, then buy a 10-year Government of Canada bond. All you'd receive is just under $12,000 a year in interest payments, and then you get to pay tax on it. This is a huge hit compared to the $46,000 you would have received just prior to the credit crisis in 2007, and the over $70,000 you'd get 10 years ago. But that's not the most serious ramification. Interest rates should reflect the level of risk the lender is taking, but the excessive central bank manipulation makes that no longer the case. I mean, for example, interest rates on Spanish and Italian government bonds are less than those in the U.S., which is a total joke predicated on continued central bank bailout of any problem. Investors are saying if something goes wrong, no problem, central banks will rescue us. Central bank manipulation of rates has also encouraged a massive misallocation of resources. I mean, you can't get ahead owning bonds or a savings account, so you buy other things like stocks. But many are no longer bought on the basis of value, instead are speculating on unlimited central bank intervention if that's a problem in the stock market. Both bonds and stocks have been bought primarily due to central bank actions, but the scary part is what happens when central banks push interest rates higher and monetary policy tightens. Well, I'm not sure the central banks know, but that sure scares the heck out of everybody else. I mean, the reason for owning them is going to be gone, and so will the buyers, and the consequences could be serious. My name is Mike Campbell. Join me Saturday for Money Talks.